we're going to talk about incorporating as a health professional and if it's right for you and will it save you money. Just a note before we start, this Lunch and Learn is going to cover Canadian-based tax and bookkeeping standards, but we do have an event planned for early August that will cover the same content for anyone from the US. So just keep an eye out for the event details in the group very soon. Right, on to ClinicSense. For anyone who is considering ClinicSense or is not familiar of what we offer, here's the deal. ClinicSense is an all-in-one practice management solution and is their mission to help you run and grow a successful business. So what makes ClinicSense unique is how easy it is to use. It's actually been rated #1 ease of use software for 4 years in a row by Capterra. We're very proud. On top of that, it's the amazing customer support and all the tools available to help you simplify running your business. The charting is easy, fast, customizable, and HIPAA and PAPIDA compliant. Scheduling is simple for both you and your clients. Invoicing, payments, and reporting tools help you feel confident about your finances. And the marketing tools will help you build and maintain really strong relationships with your clients and increase retention, client retention, and manage your business reputation. If you're not a customer and are intrigued to try us out, we do offer a 14-day free trial. Give us a shout in the comments and we'll get you signed up. On to the next one. I have the pleasure of reintroducing Cass. Cass founded the Tyagi Group in January 2020 after having an amazing experience with their health team, and they wanted to give back to the health industry. We are forever grateful. They educate and train health professionals on their business and tax requirements so they can feel empowered in their business finances. I won't take up any more of your time. Cass, take it away. Thank you for joining us.
Hello, everyone. Welcome to our chat today about incorporating. And honestly, the big question probably on everyone's mind right now after just making your big income tax payment is, can you save money by incorporating? And what does that even look like as a health professional? We're actually going to do a bit of a deep dive into what does incorporating look like so that you understand the admin, the legal, all of that requirements as well, which I think is not that the finances aren't an important factor, but I think that those can even outweigh some of these financial decisions as well. And we'll talk about some other tax planning strategies that can almost be equal to incorporating if incorporating isn't really something that you're wanting to administratively get yourself into as well. So today the goal is to talk about pros and cons of your business structure options. So for most people on this call, you're probably not incorporated yet. So that means that your default is a sole proprietorship in Canada. And then we're just deciding on if we want to move into a different type of business structure and what does that look like from a tax perspective. We're also going to talk about paying yourself from a corporation so that you understand what that looks like if you do decide that incorporating is the right move for you. And of course, how much tax you can save by incorporating, a quick little hit list. Actually, that section is probably the smallest out of all of these. So maybe the name of this webinar is slightly misleading, but I do want to walk you through a lot of information and we will talk about it at the end as to what this looks like. And honestly, learning this business structure and tax rules is just the best foundation for setting up your business for success, making that conscious decision about which type of business you want to be in so that you can be really confident with that going forward. Quick disclaimer before we get started, by accessing and participating in this training, you understand that this is not accounting advice. It is only meant for education and information. And I'm going to double down here and say it's also not legal advice as well, because there's a lot of legal stuff we're going to be going through. Please do feel free to add your questions in the chat at any time, and we'll just kind of field those as we go through. If anything pops up, I'll just get interrupted and ask those because I know this is going to be a really heavy topic for everyone today. So I hope you're all fully caffeinated just like me. So let's talk about the different business structure pros and cons so that you can make that informed decision about what structure is best for you. Again, for most people, you're defaulted into that sole proprietorship, but we also do have other options such as going into a partnership. Not very industry standard, but we will talk about it. And then for corporations, you have the option of a professional corporation or a general corporation. So there's a few different options to you. And this is where even understanding the difference between your professional corp and your general corp and how to use it can also save you money because you're going to incorporate using the right one right off the bat instead of having to go back and change things later. You also might be used to terms like associate or independent contractor or practitioner. Those describe the relationship that you might have with your clinic or that you as a clinic owner have with the people who work underneath of you. But each of those, the clinic and the individuals who are working at the clinic all have the decision to make about what type of business structure they're wanting to have set up. So if you're looking at clinic ownership, it's honestly the same type of thought process as being an individual working out of a clinic as well. So a sole proprietorship is honestly the default business when you start operating in Canada. So for everyone, when you graduated, you just kind of started working at a clinic or maybe on your own, and you just kind of started tracking your income and your expenses, and you just were a sole proprietorship. That's just sort of how it works in Canada. Unless you incorporate or you create a partnership, then you're defaulted into that sole proprietorship. You're just an individual. You bill your patients in your own name, or you bill the clinic in your own name. And if you operate under a registered business name, so if you've come up with a business name, you do have to bill your clients and customers under that business name, and you do have to register that business name with the CRA as well, and then have bank accounts that relate to that business name. So it's a little bit more sort of making sure that that name is everywhere versus yourself as just an individual if you do decide to go with a name. On the legal side, you have the sole responsibility for making all the decisions of your business because it's just you. You receive all the profits, you claim any of the losses. It's not separate from you. It's just sort of your business. Unless you do have that separate legal name, then you need to make sure that things are being sort of allocated over to that other name as well. So CRA can sort of tie that together. You also assume all the risks of the business, and this is where your malpractice insurance or even some general business insurance really comes into place as well. So your risks can extend to your personal property and your assets. Definitely make sure that you have your insurance. I don't want you to be impacted in case of a lawsuit. For taxes, as a sole proprietor, you just pay personal income taxes on it. There's actually just an additional form in your tax return called T2125 for anyone who knows what that means. It's just how we report to CRA your sole proprietorship income. It's just, you know, an extra 5 pages that we add into your personal tax return. There's no separate return. It's all just kind of included in there. And then you do have until June 15th, so coming up this week, to file your taxes, but your payment was due back on April 30th. So it's very similar deadlines to if you're an employee or if you have a spouse who's an employee, that are very similar deadlines, okay? Some of the advantages of a sole proprietorship, some of the good things, because it's not all bad, right? You know, a lot of people are probably on this webinar because you just paid a lot in taxes on April 30th, like we were talking about, but there are some really great things to it. So it's so easy to set up your sole proprietorship. You just start and then you report it. It's very easy to be able to do. You don't have to proactively incorporate and work with a lawyer and, you know, update your contracts and things like that. Things can just be in your own name. You also own 100% of the business, so you don't have to worry about, oh, I incorporated with someone else and now 2 years later they want to leave. That just gets a little bit messy from an accounting perspective and even a legal perspective. You're the business owner, you get all the profits, and if you do have a business loss, you get to use that against any future income. You actually get to carry your business losses forward as well. There's no extra tax returns. It's just your one sole proprietorship return. It's the most simple way to get your taxes filed. And if the business was to end, you just can claim capital gains on the portion of the assets that you had in the business. So if you do end up selling your customer list, or maybe you bought an adjustment table or a massage table and you're selling that, you do get to claim that as a capital gain through the business, and it's taxed fairly low for individuals. There's actually a new capital gains rule that just came through for corporations. Everything is included at 66% instead of 55% for individuals. So there are some pretty good advantages to a sole proprietorship. Some of the disadvantages, though, like we talked about, all the legal liability. The business is just an extension of you. That's really the most important thing. You do have to pay personal income tax on the year that you earn that income. So if last year you made $100,000 of profit, but let's say you put $50,000 into savings, so you only actually used $50,000, well, you still have to pay income tax on that full $100,000, regardless of how much you actually used, which is where corporations can save you some money. It can be difficult to scale or expand your business if you're trying to get funding from the bank. It's a little bit more difficult. They always look at your last 2 years of income, whereas if you are a brand new corporation, there's some really great government programs that are almost guaranteed to get you funding. May also be challenging, the bank's approval. I already talked about that one. And then business continuity can be an issue as well. So if you're a sole proprietor and you're thinking about opening up a clinic, and then your plan is that in 5 years the clinic will be big enough to sell, you probably want to do that under a corporation, because then you can just sell the shares instead of having to sell each individual thing that you own. So there's pros and cons to each one, of course, but these are some of the disadvantages of the sole proprietorships. Probably the one that everyone's feeling right now is that you pay personal tax on the year that you earn the income, regardless of if you use it or not. Okay. Partnerships, I'm just going to touch on this briefly because it's not industry standard. I've had a few people reach out who have wanted to start partnerships, and then through conversations, we end up going with a corporation that's jointly owned. But you can create a partnership with anyone that you want to, where you are each individual sole proprietors. What happens is that you track all of the costs together, and then in your tax return, we actually just put in 100% of the cost, and then we allocate, let's say, 50% to the other business owner. So you are able to create a partnership where it's two sole proprietors coming together. If you're doing something really small, you can do that, or you could come up with some sort of a cost sharing agreement. Definitely, if you're doing a partnership, you will need to get a lawyer involved to come up with a partnership agreement, just to deal with things like who gets how much and how do you split things and what happens if one person wants to leave. So, the amount of legal work for a partnership versus a corporation is going to be very similar. Corporations, on the other end, are a completely separate legal entity from yourself or your business partner or from anyone. It's the corporation that will enter into contracts. It's the corporation that will lease the new rental space. It's the corporation that will have the independent contractors working for it or that works for the clinic. So it's completely separate. This is great because it means that you can actually just buy and sell the shares of a corporation really easily. So if I create a clinic and I have a general corporation, I call it like Tyagi Fitness or Tyagi Wellness, that's usually the term that everyone goes with, Tyagi Wellness, I can just almost like hand over the key to my corporation by selling the shares. That way, the new person who's buying it doesn't need new bank accounts, they're already set up, doesn't need a new accounting system, it's already set up, doesn't need new contracts or anything like that because everything is already set up. It's very easy to sell. And the corporation does continue to exist sort of forever unless you wind it up. So if you have been using a corporation and you're thinking maybe you don't want to anymore, you do have to formally close that corporation. You can't just abandon it. It's a legal and tax process as well. Corporations, again, can generally raise a large amount of capital from the banks, especially new corporations. Within your first 6 months, there's a lot of government programs that give you access to almost guaranteed funding, which is pretty fantastic. But the shareholders cannot claim any of the losses of the corporation. Let's say it's your first year, you're probably expecting a business loss because you're going to have a lot of leasehold improvements for that new rental space that you're creating. So we can't claim those. Those stay within the corporation. They don't come out onto your personal taxes. You can incorporate your business by completing the articles of incorporation through either your provincial, territorial, or federal government. There's a few different decisions to make there. You do have to decide between federal or provincial incorporation. Now, for most people on this call, you're probably just thinking about provincial incorporation because you're probably regulated by a provincial body anyways, and so that's the level of name protection that you would want. But if you're thinking about expanding and opening up multiple clinics over multiple locations, maybe you live in Ontario, you have some friends in BC, and you guys kind of want to open this together, then you would go for a federal incorporation just to get that name protection all across Canada as well. Really, the difference between the federal and the provincial, other than just your regulatory body needing to approve some of your information, is just the amount of corporate name protection, your ability to conduct businesses in all provinces, and then your cost to incorporate. It's a little bit more expensive to do a federal corporation versus a provincial corporation. So incorporating federally does provide that extra name protection, helps to promote recognition for your brand identity as well. You can conduct business in all provinces without having to go through extra incorporation in each individual province. There's a higher cost to incorporating, but it's a slightly more complex filing, so it's a little bit more admin work to be able to get that one done. Versus provincially, you don't have that name protection in other provinces. So Tyagi Wellness, if I incorporate that in BC, it could be used in Ontario by someone completely unrelated to me. And then depending on their reputation, that might even have an impact on my business as well. So something to consider. You do need an extra provincial license to work in other provinces. So if you do decide to incorporate in BC and then you decide, oh, I do actually have a friend or I'm moving to Ontario now, well, now we have to create that extra provincial license for you. It's a lower cost to incorporating and it's a little bit simpler to be able to do those filing requirements. There is we were talking about operating in different provinces. So there is a specific definition of carrying on business for that extra provincial registration that's really specific to each province. So you just have to work with a lawyer to look into that if you do need an extra provincial license, or if you don't, again, opening up a clinic space, it's kind of easy to see that you are carrying on business. But let's say that you're a therapist who is registered both as a clinical counselor in BC and a psychotherapist in Ontario, you may not be carrying on business. So you'd want to understand if you need to register it within that other body as well. Okay, a bit more paperwork each year as well. So just make sure to keep that in mind. And then also, of course, the extra paperwork and the extra cost to the extra provincial registration too. Okay, how's everyone feeling so far? Do we have any questions in the chat? That was a lot of information. You guys are soaking it all in. Fantastic. Good, I'm glad. Okay, so a lot of these decisions about incorporating, whether you do it provincially or federally, and again, I'm walking through a lot of this because this is actually a really important decision to make upfront. Because if you incorporate federally and then you try to get something approved by your regulatory body, they're probably going to deny it, and then you have to pay extra legal fees, or you have to create a new corporation and dissolve that old corporation. And I had one client a couple of years ago, it cost them almost $2,500 to change it from provincial to federal. So that's why that's really important, and almost factors into saving money by incorporating as well, right? So if you plan to operate your business primarily in just one province, then provincial is usually enough. It is possible to switch from provincial to federal later, but again, it does come with a cost. But let's say that you're operating and planning to incorporate in the province of Ontario. You just fill out your articles of incorporation. You purchase a Nuance name search report, and it's $360 to incorporate. So it's really not that expensive. You can actually do this all yourself if you choose, or you can always work with a lawyer. And I do recommend working with a lawyer. Don't necessarily work with an accountant for incorporation, especially for regulated health professionals. There's so many requirements that your regulatory bodies have for you as well. So that's very important to keep in mind, and make sure that you're talking to your regulatory body throughout this process as well. Now, once you incorporate, it doesn't just end there. You're not just incorporated. Of course, we talked about tax filings. We're going to talk about that a little bit as well. But you also have to maintain a bunch of legal information too. So your corporate articles, corporate bylaws, directors registry, forms that you filed with the government, your shareholder ledger, any notices or anything like that that you've got as well. It's really important that you're maintaining this through what's called a minute book. Now, if you're working with a lawyer for your incorporation, they should maintain this for you, and they'll update it with you annually. I just did mine with my lawyer maybe 2 weeks ago. But this is really important just to keep in mind that once you incorporate, it's not just one and done. You have to annually report your legal returns as well as your tax returns. And this is all the information that you have to keep on hand and submit to the government every single year. So there is a lot of administrative burden with incorporating. For corporations, you do have to file your taxes. Now, this is going to be a completely separate tax filing from yourself personally. So June 15th and April 30th are no longer the dates that we're working with. A corporation pays tax installments on a monthly basis as well, whereas for individuals, you typically pay it on a quarterly basis. And one of the great things about corporations is that you don't necessarily have to have December 31st as your tax year end. Maybe today, June 11th, you're thinking, oh my gosh, incorporating is totally for me. This is great. So you're going to go and incorporate maybe tomorrow. I'll give you a day to get that together. Well, now instead of your tax year end being December, and then pretty quickly you're going to have to file your taxes and pay your taxes and do all of that, you could actually make your tax year end May 31st. That means that every single year, May 31st comes around, that's your tax year end, and then you actually have 3 months before you have to file. So you're filing your taxes over the summer when you're maybe a little bit slower as well. So that can be really beneficial for yourself as a business owner too. So just keep in mind that December 31st may not be your corporate tax year end. Just depends on if you want to sort of squish all your taxes together and get it over with, or if you like having them a little bit separated. Going into the types of corporations, I've alluded to this a little bit, but there are 2 options for you. There's a professional corporation or a general corporation. Professional corps almost always fall under provincial jurisdiction, so you do not have the option of incorporating federally. And your professional corporation, you will actually have to have the articles approved by your regulatory body. And now it's your professional corporation that will pay your annual membership dues, and your professional corporation is the one that will be registered in with your regulatory body as well. So make sure that you are checking in with your regulatory body, make sure that they're happy with what you're going to be doing. And I've looked at so many of these sort of handouts that different bodies provide, or colleges or associations end up providing. They're typically always provincial. We've worked in a lot of provinces. They're almost always provincial, and they're really specific on the name that you're allowed to have as well for that professional corporation. Okay. I think that we already talked through most of this stuff. This is a lot of information for you guys. No wonder this slide deck was a bit long. Something really important in here. So again, just talking about how professional corporations are almost always going to be provincially regulated. Your professional corporation can provide services. It's like through the corporate entity rather than yourself personally. And again, you do have to register that professional corp with your college or association and keep that registration up to date. Some key features of a professional corporation, just to keep in mind before you pick which kind is best for you. Professional liability is not limited by incorporating. So this is really important because your malpractice, like opportunity for people to sue you personally, does not go away with a professional corporation. That only goes away with a general corporation. Okay, so you need to keep your malpractice insurance. That liability does not change, but it does change your ability to be able to get funding because now you're a brand new corporation. Also, shareholders of a professional corporation are all liable for that liability, whereas in a sole proprietorship, it's sort of limited to you as an individual. But let's say you create a naturopathic professional corporation with multiple shareholders, each of those parties would be liable for that liability. It's something important to keep in mind. The voting shares do all have to be from the same profession. So in that naturopathic example, it would have to be 2 naturopathic doctors registered with the same regulatory body. So an ND from BC and an ND from Ontario couldn't create a naturopathic professional corporation together because those are 2 different regulatory bodies. All officers and directors have to be shareholders. So you have to actually work in the corporation. You can't just own shares of the corporation and not be operating and working within it. And the services provided are restricted to the practice of that profession. So the ND professional corporation can only provide naturopathic and naturopathic related services. So they wouldn't be able to have a massage therapist operating as a massage therapist out of that professional corp. Are there questions for that one? That's the biggest distinction between professional and general corps. But that's a lot of words, so you guys are keeping me on my my hydration today. Perfect. A couple of other things. So your corporate name does have to include the last name and typically the first initial or the first name of the people who own it. Very important to make sure that you're naming your professional corporation correctly. Can include the given name, usually initial. It does have to say professional corporation. So Cassandra Tyagi, Naturopathic Professional Corporation. That would be the name that would be allowed by my regulatory body. If I tried to use Tyagi Wellness, I couldn't be a professional corporation. My regulatory body would not allow it. And it does have to say the health profession practice. So massage therapy professional corporation, naturopathic professional corporation, chiropractic professional corporation. Professional corporations are actually the exact same model that like medical doctors have to use as well. So they have the exact same requirements as all of you. Some advantages for professional corporations are that when you earn income, it's taxed twice, but I promise this is a good thing. You're probably thinking I'm a little bit crazy, but it's a good thing because first it's taxed at the corporate level, and then it's only taxed at the personal level when you take that money out of the corporation. And corporate taxes have a way lower rate than personal taxes. So you can end up saving a lot of money by leaving money in that corporation. There's also very low corporate tax rates if you incorporate and have income, like income after expenses of less than $500,000 per year. There's some great tax planning opportunities when deciding when, how much, and if you're paying yourself salary or dividends or bonuses. You can also income split with family members if they're doing work. Maybe your spouse is helping you doing admin work. You can actually set them up as an employee and pay them to be able to income split, which is really great. And you can choose your year end for tax purposes as well. Again, I used the June example of May 31st, but you could even pick November if you wanted to. You have up to 53 weeks from the date of incorporation to choose. Maybe you could even choose January or March, anything up to 53 weeks. Some of the disadvantages, again, just not being protected against that personal liability. So it's really important. There's also a lot of additional costs to incorporating. So you have to pay a lawyer or incorporate yourself. You might have to amend your articles of incorporation as well, depending on how it goes the first time, if your regulatory body approves it or not. You'll have ongoing annual legal fees, like we were talking about on that slide previously, all those additional things that you do have to report in. And you now have an annual corporate tax return. So it's not just your personal return, there's an additional return. Then you'll also have to have additional bank accounts in the name of the corporation. We also recommend that you invest in an accounting software as well, because there's different rules and requirements for reporting income for a corporation versus a sole proprietorship. And then you have to track your assets, like what the corporation owns, as well as how much income the corporation had. So you may even want to invest in a bookkeeper as well. So starting a corporation is a separate legal entity, and it does need some other people to work on it as well. So you may have to pay some director's fees to others who are helping you to get this set up. So corporations can be great to save you an income tax, but honestly, it can cost you more by incorporating because of these added fees that sort of no one thinks about ahead of time. A lot of people are focused on saving money in taxes, but from your perspective, if you spend $10,000 in taxes or you spend $10,000 on these other things, you're still out $10,000. So something important to keep in mind. Steps to incorporate a professional corporation. So talking to your lawyer or accountant about setting that up. Once you decide the right move, make sure that you're talking to everyone. Make sure that your lawyer and accountant are talking to each other as well. Once you get your articles of incorporation, you will send them to your regulatory body to get them to approve. Once they have approved it, then you can start operating out of your professional corporation. Okay, so that's really important to understand. And you will have to update all of your receipts to have your professional corporation name, not your personal name. You'll likely have a new registration number for the professional corporation as well. Okay. Now we're going to go on to general corporations. I promise this section will be smaller because a lot of the stuff is the same, but we are going to talk about what general corporations can do for you and why most clinics are set up as general corporations. Okay. So a general corporation can have anyone as a shareholder. It could have me if you guys really wanted me to invest with you. It can have multiple health disciplines that work under it as independent contractors. There's so much flexibility with general corporations. However, if you're still going to continue practicing as a massage therapist, you would need either your own massage therapy professional corporation or massage therapy sole proprietorship sort of underneath this general corporation as well, because the general corporation cannot perform health services. It's just sort of the way in which you collect money and pay people out, but the performance is done by each individual practitioner. Something very important to keep in mind here. Okay. If you own a clinic and you're working at that practice, the liability for the business will end with the corporation, but the liability for your malpractice will be within your sole proprietorship or your professional corporation. So just make sure that you have adequate insurance in place and in the right places. It gets a little bit confusing when we get to this level. Okay. So again, this is just creating additional costs through additional insurance. Okay. And then note that certain professionals and services are not even allowed to have a general corporation. So again, just checking with your regulatory body or your college is really important. That's really the main difference between general and professional corps. We kind of talked through a lot of that. I also just want to talk through corporate debt as well, because a lot of people think, oh, if I take on a bunch of debt and it's in the corporation and then I close down business, I don't have to repay any of that debt. And that is correct to a certain extent. Okay, so your corporation does have limited liability. However, when you're setting up a brand new corporation, typically what the bank will ask for is a shareholder guarantee. So this means that you are personally guaranteeing the information for the corporation. So you're still going to be personally liable, and you're also still personally liable for all taxes as well. So CRA can come to you personally as a shareholder to be able to reclaim all of that debt. Okay. General corps, some of the advantages. So again, income is taxed twice, once at the corporate level and then only at the personal level when you take the money out. Let's say the $500,000 per year threshold applies. There's tax planning opportunities. And in this case with a general corp, you could even have your spouse as a shareholder with you as well. Or I've seen it where siblings open up things together as well. Income splitting with family members by setting them up on payroll. You can have that multiple shareholders to split the cost with. You also split the benefits though. You can have your year end be a little bit different. And then there is that legal separation between you and your business. And a general corp is typically the best one to create if you're going to create a clinic and then try to sell that clinic in the future, because you're just able to turnkey, take that clinic. It's completely separate from your practice as a health professional. Some disadvantages, again, that cost to incorporate the annual corporate tax return, ongoing legal fees, and all of that as well. The bank accounts, the software, so it does cost money to operate a corporation. So the question just becomes, is it worth it, the amount that I'm going to be doing? Am I saving enough in taxes to make it worthwhile, or am I getting a lot of benefits out of this, right? And it's always easier if you're thinking about opening up a clinic, especially, it's easier to incorporate now and build everything under that corporation, even if it costs a little bit more. Because in 3 years, if you want to move it over to a corporation, you're going to have so many legal fees and accounting fees to be able to switch it over. So definitely incorporating earlier if you're planning on opening up a clinic, and especially if your plan would be to sell the clinic eventually, that's really important. So should you incorporate, right? That's why everyone's here. Or I guess you guys are looking to save money on incorporating, but let's talk about if you even should do it in the first place, right? So incorporating is typically most beneficial if you make more money than you need, so you can leave money in the corporation, so that it's only taxed at the corporate level at that very low rate. In Ontario, it's like 12.2%. It's a crazy low rate. BC, I think it's 11.5%. In Alberta, it's something unnecessarily low as well. So if this sounds like you, that you have more money than you need, then incorporating can defer some of that tax burden. When you do take that money out, eventually you will have to pay personal taxes though. So this is almost similar to like a retirement savings plan. Like, okay, I'm leaving the money in there now, I'll take it out later, but you're getting that benefit today. That said, the right form of business structure really depends on you and your specific circumstances. So I hope that this has opened up a lot of questions as to if you should incorporate, but definitely have a conversation with your accountant and your lawyer about this, okay? So now that you understand the differences between all of these different corporation structures, or even staying as a sole proprietorship, you can make that informed decision, okay? And again, this is not legal advice, just a lot of good information for you to start having these conversations. Okay, and here's a quick summary chart. I'm going to pause here to take my little sip of water and allow you to take a photo if you're wanting. This one is a really good slide. Just talks about the setup, tax liabilities, practice of your profession, limitations, and the fees. Perfect. Okay. Now, let's say that you've decided to incorporate yourself because a corporation actually is the best. You know what? I've probably got, $20,000 to $30,000 more than I need per year. I can leave that in the corporation, and, or I'm opening up a clinic and I'm doing this with a friend of mine and I really want to have that corporate structure. Fantastic. Let's talk about how you're going to pay yourself, because there's two different ways with pros and cons for each that also impact your finances as well, because each one is treated completely differently for tax. So if you own more than 40% of your corporation, you can only pay yourself by salary or by dividends. So this is something really important to keep in mind, because salary is treated a very specific way and dividends is treated another way. You can also take out both. So you can take out some salary and some dividends as well. There's a lot of sort of mixing up that we can do in here. For salary, this is what you get paid from your corporation for the services that you perform. This is where the concept of the corporation being separate from you really starts to kick in, because the salary is an expense to the corporation. It reduces corporate income tax payable, but it's included to you at 100%. This is just like having, a job, right? You have a job from your company. Dividends, on the other hand, are for after-tax earnings that are paid out to shareholders. A dividend is not an expense to the company, so the company will end up paying more income taxes, but then you as a shareholder get a really good tax rate on the dividend income that you take out. On the corporate side, it's going to pay more taxes. Personal side, the dividends received are taxed at a much lower rate than salary, which gives you less personal tax payable, okay? So it can save you a little bit in tax. But really, there's a decision to be made because of your personal circumstances. So things like Canada Pension Plan, Registered Retirement Savings Plan, even childcare deductions really factor into taking out salary versus dividends, or both, and how much. Salary, you get legally recognizable income. So it's actually a lot easier once you're on salary to go to the bank and get your mortgage renewed, because you just show them your last couple of pay stubs and you're all good to go. You typically set yourself up on an annual salary, so it's usually a steady and predictable income instead of the fluctuations that you get with a sole proprietorship. You just get that sort of stable salary throughout the year. Helps you to better budget on the personal side as well, and again, easier to apply for those bank loans. It's also easier to save towards your retirement through CPP contributions, and salary is the only one of these options that allows you to increase your RRSP contribution room as well. So if you were to take out exclusively dividends, your RRSP contribution room would not continue to increase each year. And then, of course, besides paying yourself, you can income split a reasonable amount to employees that are related to you, like your spouse or your children, for actual work performed. Some of the other great things are that there's fewer surprise tax bills. So you'll just have tax taken off on every single paycheck that you have throughout the year. And you may even get a refund if you end up contributing into your RRSPs. The corporation does take a deduction, so the corporation will pay less in taxes, and salaries can be paid out to make sure that your corporation doesn't earn over $500,000 per year, which is really important from a tax threshold perspective. The tax goes up by 18% in corporations after $500,000, so that's a really good one to watch and keep in mind. Salary, some of the disadvantages are that you do have to register for another account with CRA, so it's an extra admin burden. You also have to remit monthly payroll deductions to CRA by the 15th of each month. Otherwise, there's more possibility for fines and interest and penalties. And depending on your point of view, the Canada Pension Plan contribution can be seen as a cost to you. I personally like it because it's a forced retirement savings, but not all people agree with me, which is totally fair. You also have to file a T4 annually for each employee. So again, just more admin, and then regular payroll deductions mean less cash in your pocket each pay period because your tax is already being prepaid over to CRA. Dividends, on the other hand, are the simplest way to pay yourself. You just e-transfer. It's very easy. You don't have to worry about withholding taxes. You don't have to worry about anything. You can take it out anytime, so you can optimize your tax situation. For example, you would never take out a dividend in the last couple of weeks of December. You'd wait until early January so that your personal tax bill is sort of deferred by a full year, right? You only need an annual T5 filing, which your accountant will typically do with your annual corporate tax filing. You do pay less personal taxes as compared to salary, and then you avoid mandatory retirement contributions to CPP. Some of the disadvantages, though, are that dividends are issued based off of share ownership. So this is where you want to make sure that you have this set up correctly from the start. If you and your business partner are going in together, you would have to take equal 50-50% based off of share ownership for that dividend. Receiving dividends instead of salary does prevent you from claiming certain income tax deductions like your childcare costs. So if that's something that you do have in your household, that's really important that you can't just have all dividends. You need at least some salary. Dividend income, again, does not increase your RRSP contribution room. Not having withholding tax deductions on a regular basis means that you do still have to save for your taxes each year. There's less expenses to deduct within the corporation, so the corporation will have a higher tax payable. And then, of course, my favorite, without CPP and RRSP contributions, you have to be really mindful of your retirement planning and retirement strategy. Typically, some clients who incorporate, they're like, oh, I don't want to do salary and it's just for me, especially in a professional corp when you're just getting off the ground. So I'm okay with doing this for, a year or two, but after that, you're really sort of playing that short-term game instead of the long-term game when thinking about your retirement. And the right answer is that there is no right answer. It really depends on you and your own circumstances. Again, first few years of practice, you're probably not making enough money to cover your expenses. So that's something to keep in mind as well. The key is for your business to be able to at least cover its expenses, right? And take out a consistent amount each month for yourself before you really set yourself up on salary. As your practice builds, you can continue evaluating your income, maybe every 3 months or so, and just see how much should I be taking out, and then should it be in salary or dividends, depending on your personal circumstances and situation. But try to make sure that you're paying yourself the same amount each month. The goal is for you as a person to not feel the fluctuations that your business is going to have, right? Right now, I know it's slowing down for everyone, and then in the fall, it's going to pick up like crazy. So we're not wanting to feel that on our personal finances so that we can still have the same sort of value of living throughout the entire year. Here's a good example. So if you pay yourself evenly, your sales are going to be very high in November and December, and you're making a lot, but you are disciplined and you only take out $5,000 per month. So then in Jan and Feb and March, when you have a little bit slower sales, you're still able to take out that $5,000 number. And you also get a personal tax deferral because in December, you have $5,000 left in that corporation. So you're not paying personal income tax on that until you actually take it out. Again, leaving in the money in the corporation is the only way to really save on taxes in your corporation. Just by the fact that you incorporate doesn't mean that you're going to save money in taxes, because the idea is that everything is still taxed the same as long as you take it all out. So if you're reinvesting the money in your business, that's an expense to the business. That's not really leaving money in the corporation. You have to really leave it in the corporation and not really do anything with it. Okay. Also, leaving money in your business checking account, make sure that you're opening up something like stocks, bonds, GICs, something like that, so that you're getting a good return, not just leaving the money in there and only earning 2% when inflation right now is 7-8%, because that's also not going to serve you as well. And then just a quick note that on these investments, passive income is taxed at a higher rate than your regular business operations. So it's about 33% within a corporation. So again, just other things to think about, that it's not just I incorporated, I'm going to save money because I incorporated. It's having that strategic plan about what am I going to do with this money? How much am I going to leave in? And what is that going to look like? Okay, I promised I would get to how much tax can you save. We're actually almost at the end and we're doing pretty good on time. This is a lot of heavy content. Anything in the chat? Any questions going on? Oh, I see some chats in. Okay, I do see one good question. So when I say regulatory body, how does that work in an unregulated province, such as Alberta? So in Alberta, you would create your specific provincial company that you're needing, but you don't have to get those articles approved, which is really nice. So you can almost like use any name. You don't have to use Cassandra Tyagi Massage Professional Corporation registered in Alberta, which is really nice. There's no regulatory body to send those articles to. And then we do have a question from someone about in the US. To be honest, I know that you guys have LLCs and all of that, and I don't have the answer because this is very Canadian focused. I'm not sure what the equivalent would be in the US because I know there's so many different options for you guys. And I think it's different by state as well. Canada, it's nice and easy. We just have or don't have regulatory bodies. Okay, so now the multi-million-dollar question that everyone's here for. How do I save less, like how do I pay less taxes? Because that's really what I want. That's why we're all here. Thanks everyone for sticking through to the end. So in my honest opinion, there's really not that much that you can do when you're picking salary versus dividends. Okay, so other than leaving money in a corporation so that you're not paying personal tax on it, if you're thinking, oh, I'll take out 100% dividends and I'll save, you actually don't. So this is due to a Canadian tax concept called integration. This means that the total amount of tax, if you take out salary, you'll pay $20,000 of taxes. If you take out dividends, between the corporation and your personal taxes, you should still pay that same $20,000 number. It's just who's paying it. Honestly, I worked with a couple of clients last year. Maybe they saved $300 when they were taking out all of the money, right? So you don't really save that much by taking out dividends versus salary. It's really that mechanism of leaving the money in the corporation to take out at a future date so that you don't have to deal with personal taxes at all. Okay. The goal of the integration is make sure that you pay the same amount overall. That's what the government is trying to do, unfortunately, for all of us. Okay. Salary tax treatment, just a quick overview. In the corporation, salary is deducted. So the corporation is not going to pay tax on any salary that it pays to you, but as an employee, you include it at 100%, right? You receive your net salary each month. Dividends on the other side, the dividends are paid, what the tax is paid by the corporation predominantly, but you still do have to pay personal income tax on it. It's just at a lower rate. And the deduction that you get, basically, your dividend is included as income, and then you get a deduction. That deduction is meant to be how much the corporation would have paid in taxes, okay? So it really just depends on your province and where you live, your personal tax rate, because it's different when you're tax planning at $50,000 or $200,000 as well, right? Because at $200,000, you're gonna save a bit more. But you also might wanna leave some of that money in the corporation. So the best option, really you want to maximize your tax or minimize your tax exposure, maximize your tax savings. So you want to balance all of these considerations that we kind of talked about, right? So you probably want to pay yourself enough salary to avoid crossing the $50,000 or $500,000 small business deduction limit. All corporations get, there we go, a decrease from their tax bill. So it's a really easy way to save, but there are restrictions on lower tax rates as well. Okay. Also paying into CPP, unlike sole proprietorships, incorporated business owners have the option to opt out of the CPP program. So ask yourself, if you're saving, $5,000, $7,000 per year, are you actually saving that for retirement, or are you just spending it but not having any money for retirement when you do need to retire? So that's a really important one that's close to my heart. That's why I keep emphasizing it for you guys. And also paying into RRSPs. So you may want to pay into RRSPs to plan for your retirement. Whether you're putting your money into an RRSP or you're saving the money within a corporation, it's pretty much treated the same, right? So you could use either of these mechanisms if you're an individual working on your own, who's just thinking about a professional corporation as as a solo practitioner. You can also take advantage of things like the home buyers plan or the lifelong learning plan, or contributing into your spousal RSPs as well to better tax plan for retirement. Okay. Remember that you can only pay into your RRSPs if you have employment income, so either sole proprietorship or salary. Other more complicated tax planning lets you split your dividend income with family members through trusts and shares and discretionary dividends. And there's so much really cool stuff that can be created. There's also some really cool insurance contracts that you can come up with within a corporation once you have enough money sort of saved up in there to earn even more money. So corporations can be super beneficial. You just need to leave the money in there and then let the corporation do those cool things. Again, additional fees to incorporate. And the big question is, it can cost up to $10,000 or more per year to have a corporation. So are you even saving $10,000 in income tax? Is it worthwhile? And there are some cases where it can be yes, right? There are some cases where you're opening up a clinic and the answer is absolutely yes, that this cost is worth it. But there's some cases where it might be no. So if you're doing it, should you? I don't want to scare you away from incorporating. I know it can cost some money. You can do it not necessarily cheaper, but you can learn how to do your own bookkeeping. You can learn to understand QuickBooks. You can work with a good lawyer and accountant who aren't going to charge you exorbitant fees as well. So if you're opening a clinic, definitely recommend to incorporate that legal liability coverage, and that extra separation between you and your contractors is just absolutely worth the additional fees that you're going to have. If you're an individual though, and you're just thinking, oh, maybe I can save some money on taxes by incorporating, it's really about saving the money in the corporation so that you don't take it out personally. It's just another form of retirement savings. And again, you could also just put that into your RRSPs. Okay, so now that you know the different tax types of businesses and the tax impacts of each, you can make that really informed decision about what business structure is going to be the best for you. Just a quick recap here before we sign off and open it up to questions. So there are 3 types of business structures that you can choose from. You have 2 options for paying yourself from a corporation. There's tax treatments for each of these is so completely different. And just make sure that you are talking to an accountant or a lawyer about your taxes savings. It's really important just to make that informed decision right off the get-go and save the money instead of incorporating and then regretting it later. That was a lot of information. You guys held up well. I'm very impressed. And of course, this is recorded, so please go back and rewatch this.
Thank you so much. That was so much to take in, but yes, it's recorded. Thank goodness for technology. We can rewatch, go have a look at the screens, take all the screenshots we need, and I'm sure people might want to reach out to you. So where can we find you?
Yeah, absolutely. So our website is tyagigroup.accounting.ca. You can book in a free discovery call there. Or if you search on our blog, we have lots of resources, and we do have another sort of freebie about incorporating. We post blogs every couple of weeks on incorporating in different business topics as well. And we do also offer just like a one-time 1-hour consulting call if you just want to talk to an accountant one time about incorporating, but with the actual information for you about incorporating. We would need your last couple of years tax returns and just to know a bit more about your family situation. And we could help you to make that really informed decision if that's something that you're really leaning towards now as well.
Amazing. Thank you. If there's no more questions from anyone watching, thank you for your questions that you put in already. If there are no more questions, if you do have questions, post the chat, send us a comment into this chat or on the event, and we'll pass them on to Cass. But if there is nothing else, thank you so much again. This was awesome. I think all our brains are just running through numbers, but this was so good, so good. Thank you so much. And we look forward to the next one already.
No, that was great. Thank you everyone for coming.
Bye. Thank you.
Bye.